Hey everyone, and welcome back. Have you ever wondered how some people seem to build wealth effortlessly in real estate, while others just don't? Well, a lot of their secret isn't just about buying the right property, it's about mastering the tax code. We're talking about smart, legal moves that can save you thousands of dollars. Today, we're breaking down the top 5 real estate tax benefits in the US for 2025. And believe me, you're going to want to take notes. This is the stuff that separates the savvy from the rest. So, let's start with the absolute basics, the things you can deduct from your taxes just for being a homeowner. The first big one is mortgage interest. Think of it like this. A significant portion of your monthly mortgage payment isn't just paying down the principal of your loan, it's also paying interest to the bank. The US tax code lets you deduct this interest, which can save you a ton of money. As of 2025, you can deduct the interest on up to $750,000 of your home loan, or up to $1 million if the loan was taken out before December 15th, 2017. And don't forget about property taxes. These are the taxes you pay to your local government to fund things like schools and public services. You can also deduct these, although there's a cap. The limit on the SALT deduction is $10,000 or $5,000 for married couples filing separately. And for those of you who've made your home more energy efficient, there's even more good news. Things like new solar panels or energy efficient windows might make you eligible for federal tax credits, which are even better than deductions because they reduce your tax bill dollar for dollar. Plus, with so many of us working from home now, a part of your home expenses can be deducted if you have a space that is used exclusively for business. It's a great way to turn a normal living expense into a tax saving opportunity. Now, let's switch gears and talk about a real game changer for anyone who invests in real estate, the 1031 exchange. This is a super powerful tool that lets you sell an investment property and buy a new one without paying any capital gains taxes on the sale. The key phrase is deferring those taxes. It's not that you never have to pay them, but you can put them off as long as you keep rolling your profits into new investment properties. The rule is all about what the IRS calls like-kind exchanges. This just means you're trading one piece of investment or business property for another. It's not for your personal home. To use this, you have to be very careful with the timing. Once you sell your old property, you have to identify the new one you want to buy within just 45 days. Then you have to complete the entire transaction within 180 days. It's a tight deadline, but if you follow the rules, it can be a fantastic way to grow your real estate portfolio without the immediate burden of capital gains taxes. First off, let's talk about depreciation, which is a huge benefit for real estate investors. It might sound complicated, but it's really just a way the IRS acknowledges that buildings wear down over time. Think of it like a car. The moment you drive a new one off the lot, it starts to lose value. The IRS lets you take a tax deduction for that wear and tear on your rental property, even if its market value is actually going up. This is what we call a non-cash deduction. You don't have to spend any money to get it. For residential rental properties, you can depreciate the value of the building itself, not the land, over 27.5 years. For commercial properties, it's over 39 years. This means you get to subtract a portion of your property's value from your taxable income every single year, which can be a significant savings and is a key reason why so many people get into real estate investing. Now, let's talk about the ultimate tax benefit for most homeowners, the capital gains exemption. This is the one that can save you hundreds of thousands of dollars. When you sell an asset, like a stock or a piece of property, you usually have to pay a tax on the profit you make, which is called a capital gain. But the government gives homeowners a massive break on this. If you sell your primary residence, you can exclude up to $250,000 of the profit from being taxed. And if you're married and filing jointly, that amount doubles to a huge $500,000. The only catch is that you have to owned and lived in the home for at least 2 of the 5 years leading up to the sale. This is a game changer that allows you to sell your home, move, and keep a lot more of the money you've earned from its appreciation. Now, let's get into the pro-level stuff. This is for those of you who are serious about real estate and want to supercharge your tax savings. The first strategy is called a cost segregation study. Now, that sounds complicated, but it's really not. Think about it like this. When you buy a building, the IRS says it's going to depreciate over a long time, 27.5 years for a residential property or 39 for a commercial one. But what if you could take bigger deductions sooner? That's what a cost segregation study does. It gets a specialist to come in and break down your property into all of its individual parts, things like the landscaping, the appliances inside, and the lighting fixtures. These are all things that wear out much faster than the building itself. By reclassifying these items, you can depreciate them over a shorter period, say 5 or 7 years, which means you get to take bigger deductions much earlier in your ownership. This can create a significant tax benefit, putting more money back in your pocket to reinvest. Another big one is the pass-through deduction, also known as the Section 199A deduction. If you're a real estate investor, some of your rental income may qualify for a deduction of up to 20%. This can be a huge tax break, but it's not a free-for-all. The rules can be pretty complex, so you'll want to make sure you're structured properly and that you meet the income level and other requirements. Finally, a really advanced strategy is something called real estate professional status. The IRS has strict rules on what counts as active and passive income. Most rental income is considered passive, which means you usually can't use losses from your rental properties to offset your regular W-2 income. But if you can prove you're a real estate professional by meeting certain hours and material participation requirements, you can potentially deduct all of those rental losses against other income you have, like a salary from a day job. This is a game changer for serious investors, but it requires careful documentation and a lot of work. These advanced strategies are powerful, but they are also complex and must be handled with care and in full compliance with IRS regulations. It's always smart to talk to a tax professional or a real property attorney to make sure you're doing everything right and getting all the benefits you deserve.